Hey guys, the objective for today's discussion is one of the requests that I have received several times on my Twitter personal account, and plus several of you have reached me to understand, okay, what are the different things that one should discuss and take in consideration while doing private investing. So let's focus on that part. Okay, in this particular reference, I think it is very important to mention that all the discussions that we are going to have is for the purpose of education, information, entertainment. There is no financial advice here. There is no paid endorsement or anything in this discussion at all. In general, I think what is important first is to make frame like what is private investing. Private investing is something that is generally not available in public market. So, for example, these could be companies which are not yet IPO. This could be startups which have VC funds. This could be alternate investment instruments which are fractional ownership for example, a plane or a cruise or premium real estate, for example, in Monaco. So it could be a lot of things. Sometimes private investing also involves some very structured kind of deal, getting origination of a certain kind of business in a certain kind of territory with preferential returns if it works out. So these are these are pretty much the investing opportunities that are not generally open in market. There have been efforts to make it democratized, but yeah, they are successful only up to an extent. So one of the first question before you decide or you do private investing is the bigger question is, do you really want to do it? And I think that to me that's the most important part, because when I discuss in detail with a lot of people, they really don't want to do it. You need to understand that private investing is highly liquid. Your funds can be locked for a very long time. The assets you invest are not in public. That means the governance and the scrutiny, the financial statement and the information that is available out may not be up to the mark. It's not like a stop loss that my investment goes down and I can exit. These are highly liquid. If you get a sucker, you just have to live with it. You just cannot get out of it that easily. The barriers to entry is very high, and you need to pay high fees. I mean, I see people discussing about paying $1 fee on a stock trade. I mean, here we are talking 20% of your profits, and if you lose, loss is yours. So it's a high stomach, high risk investing. So it's not for everyone. The second part is, even if you want to do it and you say, okay, I mean, yeah, what the hell, I really want to do it, or do you think you are sophisticated enough to do it? It's not available for everyone. Okay, it's not like world made equal for all. So a lot of places you will go, there is a requirement that you need to be an accredited investors. Accredited investors could be someone who has a very large amount of assets, or who can demonstrate that he has a sizable income, in addition to the understanding of the nuances and the complexity of business and finance world. Okay, these requirements can be very steep at times, and they can vary differently from different companies and different countries as well. Some of the areas, for example, different venture funds or different angel funds, they have a lower requirement for this, and that could be one place to start for many of you if you really want to do it. To me, the most important is always the bad and ugly, as I discuss, is these are highly risky assets. These are highly illiquid assets. You'll be locked for a long time, and you have to invest in very large chunk. I mean, it's not like, okay, let me take a $500 position in this Spacex. No. I mean, even if today you want to go in market and you say I want to take 100K position in SpaceX, it's very unlikely to get allocation easily. So as a retail investor, if you are looking for someone, looking at someone like who needs to start it, these are the questions you need to consider. If you are sophisticated investors and you are already doing it, then I should be asking your advice instead of giving you my advice on that part. Now, how to do it? Okay, like somebody who is starting, how to do it? I mean, there are some very simple platforms to start with. Okay, microventures. Microventures is pretty unique in a way, like it allows access to some of the companies, actually sometimes large amounts, sometimes even their convertible structured notes and others instrument as well, sometimes at a very low price point and a low allocation amount in general to that. Equity Gen is another one. I mean, it's one of the platform where you can find a lot of companies, and you can start. I think the minimum ticket there is like 10K for your first deal, and then it goes to 20K for certain other deals, and then 50K onwards. So you see, I mean, the amount gets steep, and now we are talking the lowest tiers of this investing. There are other platforms like this. There is one I came across was like One Crowd or Our Crowd or like Caprish Capital. I also remember some of my friends invested in Spacex via Space Angels. I cannot vouch for any of these, but I mean, this is what I have done investing, and this is what I have seen. Space Angels, I think the minimum ticket they managed like what 25 or 40K, something like that. Some of my people in my circle have reached me to ask about SpaceX, and I recommended them. I shared with them that that Space Angels was able to allocate some of the funds to other friends, and they reached, and what they learned is like 25K is the minimum ticket they came up with. The everything that comes with these platforms, I mean, you can see that you can access suddenly go and see a lot of companies, but there is, so what's the catch? I mean, what you are missing in this is part. The catch is that a lot of companies on these platforms are just suckers. I mean, they are losers. They are a lot of pump and dump that happens at times that companies are trying to raise valuations, and these are platforms. They don't vouch for companies. That means all of your risk, all of the DD you do is entirely yours. At best, they can share with you a pitch book document or a crunch-based report or something like that. That's all. So at the end of the day, you have to make decision, and you have to find for allocation that you go and say, okay, I am interested in a company A. I want to invest this much at this price, and if there is someone interested, then they will likely respond and try to match the buyers. Now we are talking a process that could happen over 1 week to 6 months. I mean, it's not like bid and ask that is happening in a regular market. So that doesn't happen. The biggest challenge that comes with these platforms, and which I hate the most, is if there is a good company and you want to go and invest in that, and everyone knows about it, so you have to be on that platform on a Pacific time, 12 p.m. to click the button. If you are delayed by a few seconds or a minute, that's it. Allocation is gone. When the company is hot, there are so many people on those platforms. It's a bit of lottery. So when you are taking this much risk and you really wanna get into private investing, you really don't wanna be living that kind of life on the edge, because normally what happens, it's very frustrating, and then you tend to do things. I mean, okay, you didn't invest in a company, and then you make some rash investment decisions on other companies which are available on the platform, because investing in pre-IPO on this platform is so easy. The next level of platforms, I mean, I would like to mention is the one I like up to a certain extent is Forge Global. The reason I like Forge Global is certain because I have a dedicated relationship manager. I can drop to a message to that guy, and I can ask, so say, do you have a location of this company? And he can tell me whether this allocation is not there or there, what's the last price transacted. He can look around on the platform if somebody has, from other relationship manager, if somebody is looking to exit their position. Okay, so there is a bit of relationship, there is a bit of discussion. It's not much, but yeah, I mean, in a world where you don't have a lot of opportunities, it's okay. Okay, but then the ticket size goes higher. I mean, the ticket size is almost 2 to 3 times what other platforms are doing on that part as well. Then the next category that comes is you invest via funds. Okay, I mean, we all know, I mean, Ron Barron's fund has allocation in SpaceX. You know, Ross Kerper has a managed fund which has 5% of SpaceX allocation. So the process, you get access and exposure to the companies you want. Another process in this particular case that comes is these platforms, they have like it's a portfolio approach. That means you have 5% SpaceX, then you have other. So basically, you invest in a portfolio which is managed by professional people, and given that they are doing good job, you can say that your money is slightly diversified, a bit managed, and you can try to stay a bit relaxed. If you like these people, and these people have done well, and they have right ethics in terms of fiduciary duty and other things. The cons is, if I want exposure to SpaceX, why the hell should I invest in other companies? And this is where the pure play investing comes in play. And this is where the market for a lot of niche boutique PE firms and a lot of like selected high venture funds comes in. In these companies, so their charges also goes high. The barriers to entry is high. They will take like 3 to 4% upfront on good companies. The carry can vary up to 20 to 25%. Maximum I have given is 25% one of my investments. And then you have management fees. So you pay a lot. But you get a relationship. Like for example, if I work with a company and I give him a call that he will send me the message that these are the allocation coming, and I'll give him a message that, okay, block this for me. So that means I don't have to be on the system. That they will block it for me. They will wait for me 2 days or a week to respond for it. They will give me time to transfer the assets and understand and talk to them and different risks. They will share their own DDs, and sometimes some of these companies actually entering these investment as a principal investor. So you get to know these companies. You get sometimes even you get to talk to the senior management of these companies or to raise questions if they bring you in. So yeah, that's an advantage that can come with it, and it's your choice and it's your prerogative that whether the fees you are paying is actually worth it or not. Okay, I cannot tell you that this is right or wrong. This is every investor is different, and you have to make your own mind and your own choices on this. There is another way of doing it is which personally I don't like is going via banks, and banks have certain funds which do this kind of investing, and you can invest in that. The problem I find with banks and these funds are, see, if you look around is, this is a highly risky and highly liquid market, and banks are the most risk averse institutions. That means they make it highly opaque, highly risky, highly illiquid markets to even more opaque and more illiquid for you, and even charge more exorbitant amount of fees. And in the banking world, the concept is beating the market. That means if you are the market is doing 30% and they do 40%, they can go and say that, okay, yeah, we have done better than market. You are taking a much higher risk. Your return should be higher than that. And in banks, the premium deals only goes to the premium customers. Okay, that's how they engage them in their wealth management business. So, and then you have a lock-on period. Like for example, I went by a bank. I had a lock of 10 years. After 4 years, I realized that they are charging like quarterly fees and all that, which is too high. I'm barely making any returns more than market on this, and then I say I want to get out, and since I got out, I have to pay penalties for remaining 6 years. And after that, once the deal is settled and everything, I didn't make any money out of it. So like I said, I mean, it's a highly liquid market. The bank funds has made it even more impossible for me, and yeah, it was frustrating. So my understanding came is better I do it myself rather than doing it via bank. And yeah, I mean, I'm not here doing this to beat market or do anything. My idea is I like certain companies. I want exposure to that companies. Then the last part is why private investing is something that should be in one's portfolio. See, I remember one of the big news that I read in 2004 when the Google came for IPO, that there was news like almost like all the employees, a very large section of employees became millionaires. I said, dude, what are these companies? How do you get to these things? How do you get even these shares which are like not in market? I mean, and I realized that when it came, the valuation was really high. I mean, relative to those days, and it was quite a big news. But then financial crisis happened, and now we are injected in a world where Feds are pumping money like anything. So there's a lot of money available to raise, and this is where companies are able to stay private for longer. For example, Stripe in secondary market is already above 150 billion. Spacex now is 100 billion. So question is, by the time these companies will come to market, they will probably be already 200, 250 billion dollar kind of companies. And a lot of people knew Stripe is a good company or SpaceX is a good company when they were 10 to 20 billion dollar company. Like for example, I wanted to invest in SpaceX when it was 10 billion, but I couldn't found that time. I barely managed to get allocation when it was 36 billion. Okay, and yeah, now it is 100 billion. Okay, so thing is, you really wanna ensure that you ride this wave. So there is a point which I always call like a just PIP or mid, like a series B onwards PIP, that you have a certain essence of the companies which are which has good signs. Okay, the risk is always there. Okay, so you can ride on these things. I mean, like for example, I identified the buy now pay later trend very early in, before like the COVID was happening, and when the COVID happened, I realized that this trend is actually kinda likely going to accentuate when people are getting weekly payments from the governments in terms of stimulus in European and US market. And this is where I entered in Klarna, and since then, I mean, Klarna has gone 10x. So you have this is where you get to play your ideas. Okay, the risk is yours. You need to go with large chunk of your net wealth, because unless you don't qualify, you don't get the allocation. So that's the risk comes with it. Okay, the other way of doing it is in the companies which are like going into pure angel and seed funding, kind of a very early stage funding. Okay, this is where I see like my friends have portfolios, they have investments in over 100 companies, and frankly, 90% of these companies will go bust. I'm not very, I mean, I'm not in line of that, because that you keep a portfolio of companies who are like this, and then you have a portfolio of companies which are like index fund and blue chip. And then there is this is what I call the valley of death. Because to me, the the larger appreciation is happening in this reason. Okay, the risk is high even for the best of the companies. And even one of my the companies are like a most Palantir is a good example to mention it. See, Palantir started in 2003, 2004. Facebook started a year after, and if you see like Palantir stayed private for long, Palantir valuation is nowhere near Facebook. So yeah, things can be ugly as well if you have stayed in Palantir for that long. I mean, yeah, you didn't make that kind of return. Also, like for example, if you see the Palantir valuation between 2015 until DPO, it was kind of stagnant, and there was even places where the couple of banks actually marked off. People sold shares in secondary, which was lower than the valuation that was achieved in 2015. So, if you bought Palantir in secondary in 2015, great companies, great reviews, great reports, but yeah, valuation didn't change. It actually went down. What will you do? It's not like you can sell and buy another time. It's like if you get, you really need to take that loss. And during the time, a lot of companies actually went 5x, 10x, 20x. So being in the right company is has its own risk also at times. So uh, think about it. If you really want to do it, do you really have stomach for this kind of volatility and risk? Because we are small investors, that means making an investment like this could be sometime 10, 20% of our net wealth, which can get locked for 3 years, 5 years, 8 years, which can be wiped out. Uh, Everyone doesn't have the stomach for that. So before you even think you should do it, the question is, what's your risk appetite? What's your strengths that's going to look into it? And if you can build a strategy and approach about it, yes, these are markets and these are opportunities that you can explore. The next step then it comes is on the how part is, because you may not have access, you may not have the right credit profile. That means you need to work towards it with that time. You may need to work also. So how do you work? Like for example, some of my friends in US, they went with something called like Arizona Tech Fund, which gave them access to some of the companies, including ChargePoint, very early Electrify America, which they felt was a so they managed to get early. They didn't have that kind of high amount of funds, but yeah, the barriers were low. But what they paid in return was high risk. So their selection worked out because they did a good DD on that part. A lot of people may not be able to do that part. So it's a balance. If you want lower barriers to entry, then you are exposed to higher risk. If you want to reduce the risk, then your barriers to entry increase. And whichever way you look, I mean, these markets are lucrative at times and risky at times more than the public equity. One of the big advantage I see in public private investing at times is that, for example, this year, the public portfolio is pretty much stagnant. This portfolio has not gone anywhere for people like me from February until now. But my private companies are shielded by whatever happening in market. I don't care about what does the job report look like, what does the consumer index look like, what's the inflation index look like. These companies are shielded by this because everyone wants to jump on good companies before pre-IPO, and they wanna enjoy the phase where there's a tacit pump that comes, either you are riding a SPAC or you are riding a company before IPO. So these things don't matter practically. The only thing that matters is the company itself. So in a way, uh, the company risk and the sector risk is predominant before these companies coming to market. The market risk is not that important or that prominent at time. Of course, if market goes quite bad, as in 2008, I mean, everyone will suffer so with these companies. But these day-to-day fluctuations and all, you can really shade it off. So that's all I have to share on this one. And yeah, I mean, it's just information sharing. Feel free to take what you feel, what you deem necessary out of it. My only recommendation or advice on this part is these are highly risky strategies, and you need to be a bit of sophisticated investors. Okay, if you are someone who is just taking tips and dumping your money, I'm sorry, I mean, this is not something that you should look after. Please invest with responsibility and sincerity. I hope it helps. Bye.